think we're live. This is Value After Hours. I'm Tobias Carlisle, joined as always by my co-host Jake Taylor. Our special guest today is Zeke Ashton. Ashton Total Return Fund these days, Zeke?
Yeah, it's Ashton Capital. I'm not
Ashton
supposed to
Capital.
be not supposed to be naming the fund
I
according to
see.
compliance people.
We
So
didn't we didn't do that.
no, we didn't. So Ashton Capital is the name of the firm. But yeah, great to be back. Thanks for having me again.
Good to have you back, Zeke.
Yeah, great to have you back, Zeke. Just before we came on, we were discussing the end of an era with Buffett stepping down, and you say it's a post-value era. What is that? What's happening?
Yeah, I don't know what that means. It just sounds
It's
uh,
provocative.
Provocative.
yeah, but I do think it's an interesting historical time in the markets. I think it does kind of represent the passing of the baton from, sort of this maybe a world that existed somewhat more in nostalgia than in reality, where this notion of somebody who's very patient, who just studies businesses, swings the bat every couple of years, finds a great business at a really good price, and then holds on for 10 or 15 or 20 years as it compounds away. Um, can that still work? My gut tells me it can, but it's just harder now in a certain way. Simply because I just think the structure of the market has changed so much with all the passive flows and all that. So certainly you're unlikely to be able to catch it with really big stocks. On the other hand, I think that human nature won't really change, and I do think that it can be done. I will be interested though, you know, in terms of who the next generation of the value investors are and what they'll represent. And all I can hope for is that, obviously Warren Buffett has represented the tribe of value investing in just a terrific way, not just in terms of how he's performed, but also I think his views on, how to conduct yourself, how to behave in public, how to communicate with people. I just think those are things to really be admired. And if he'd only compounded at 10% a year instead of 20, you'd still admire those things, right? Because that seems to be a bit of a dying art as well.
Now it's all SPACs and fraud coins and
Yeah,
however
there's
else
a
you
lot
can.
of there's a lot of promotion out there for sure. And certainly the Twitter wars that we see now, billionaires having with each other all the time. It's hard to imagine, Warren Buffett engaging with the world in that way. And I do think that he's certainly taught me a lot about, how to sort of communicate with your peers and also just, even as smart as he is, and perhaps some of that humility is affected, but he certainly never comes across as if he, thinks he understands everything in the world and he can solve all of our problems.
It's crazy to think like what's the inverse of like having retail end up holding a bunch of SPAC bags for you. I'm
Yeah.
not going to name names, but uh, the inverse of that is Buffett running Berkshire for 60 years for literally zero economic value for himself. He bought those shares. He never sold a single share the whole time to like, buy a house or a mansion or a sports car or anything. Lived off of his PA, had $100,000 a year salary, and then gives it all away at the end. So literally no economic benefit, like, and built all of these fortunes for so many people and provided this this kind of guiding light for how to conduct yourself in the world. That to me is incredible and the kind of the inverse of SPAC grabs.
Yeah. I also think he, as he became more widely followed and more successful, and obviously as Berkshire accumulated so much more capital, I think he played an important role in almost the JP Morgan style of stepping into market crises and perhaps averting worse crises by projecting a needed vote of confidence into the world
You
at
mean
a
JP Morgan the man in
JP
Yeah.
Morgan, the
1910,
man,
yeah.
for sure, for sure.
Right.
And obviously, that's a very rare thing as well. So, looking back in some of the dark times of the GFC, I think him stepping in and kind of again injecting not only confidence but calmness into a market where there was just a frenzy of fear and doubt. And it certainly did feel like it could be the end of the world at that moment in time. So yeah, it's just an interesting time. And I do have a lot of hope. There's obviously he's influenced so many of us that I think that influence will continue to spread out there. And I certainly think Berkshire will continue to be run with those ideals in mind. Although I can't imagine that it will be, that it'll be run quite as well because certainly he's a generational talent in every respect.
Who steps into that role of the JP Morgan Buffett in 20 years' time?
It's an interesting question. Maybe it's not a person. Maybe it's a Blackstone or BlackRock or one of these enormous institutional asset
I mean,
vacuums.
let's hope not.
Yeah.
Let's hope not.
You know,
Oh God.
so I don't know.
2 and 20 on
Yeah,
saving the world.
yeah, yeah. So I don't know. I don't know if there will be another one. And maybe it won't be needed. You know, we can always hope.
Mm.
We can always hope.
Um,
The
yeah,
AI overlords will step in
there
and
we go.
clear all the.
There we go.
That's right. Yeah. So
Uh, there've been we've been talking about the difficulty of finding opportunities historically, but I like you, I think that there's been an enormous amount of opportunity around in small and mid cap particularly. Maybe like maybe like a 22 late 22 type opportunity set, not a 2009 type opportunity set or a 2020 opportunity set, but like a 22 opportunity set. And I think that flows going to the big end of town has sort of left this very large part of the market that's largely ignored. And you said that you've had a similar experience.
yeah, I do. I feel like this does feel like a combination, a little bit of 2021 and maybe 2001, where it feels like on the one side there's this frenzy of risk taking, and I'm talking about things like the 58th Bitcoin treasury company or anything with quantum in its name, regardless of whether they're doing anything quantum related. And of course, you mentioned SPACs again. I think the frenzy is off a little bit of the SPACs, but of course they're coming back as ways to raise capital because the market seemed to be open to that. And on the other side, I would say there are more companies today that are publicly traded that seem obviously mispriced to me than there have been in a very long time. But what you say is exactly right. They tend to be in the smaller market caps. They often tend to be without a lot of support from large indexes or anything like that. And I think that's really good for those of us who can buy them and hold them. The problem is that there's no reason they should go up tomorrow. And so, because I do think we're past the sort of midway point of this, long transition from active to passive. And I still think that, there are active managers that are having to sell small cap stocks, but also small cap stocks in the US have not really participated in this late bull market. I mean, we have not, I think the Russell 2000 is very close to where it was in 2021. And so that's 4 years. Even on the big stocks, we talked about how, if they're big, widely held stocks, that you would think that they would not be mispriced. But I think they still can be. What I think is very interesting is when a big stock puts out something that is unexpectedly good or unexpectedly bad. I think what you find is because the passive indexes don't respond immediately to that because it just depends on whether they got a flow yesterday or not. Um, the active investors who are left, there tends to be much bigger air pockets now, either on the upside or the downside. And I think we saw that recently, like UnitedHealth, which, full disclosure, we have a position in it now. This is an enormous company. I think it's the fourth largest company in the United States by revenue. It was a $600 stock during the tariff sell-off. And, 2 weeks ago, it was a $300 stock. And so a lot of things happened, and a lot of really bad sounding things certainly did happen. But to have a stock that is that widely held and that large a constituent in the S&P 500, I mean, to have it drop in half is pretty remarkable. And the other thing I've noticed is that these movements will happen, they're very violent, and then they'll kind of fill in as the flows catch up to them. So even if the news was really bad, it's kind of interesting that the stock will sell off and then it will kind of recover a lot of the lost ground simply because if there's flows coming in, it will catch its share of those flows, even if they're a smaller proportion than they used to. So it's just the market structure today is quite puzzling to me. It's really fascinating. I wish I could get my head around it better. But I think one of the reasons that I'm doing what I'm doing now and the way I'm going about it the way I am is I feel like it's okay for me to just buy really good assets at a clear discount to what those assets would be worth to a private all cash buyer who is intending to hold those assets and literally earn his return from the production of economic value from those assets. The problem is I cannot count on keeping up with any index. I can't count on getting a return at any given time. It may sit there for a year, 2 years, 3 years, and then I expect I would wake up one day and that stock's been, taken over by a larger company, taken out by private equity. Some massive, corporate change has happened. And I think we spoke about this a little bit last time I was on the podcast when we talked about David Einhorn's conversations about a broken market. And I guess I would say I'm happy that it's broken this way. Whereas in 2016, I literally could not find anything that I wanted to buy at those prices. And the stuff that I did own, there were things that I was owning mostly because I felt like I needed to own something. Whereas today, I'm quite happy to own what I own. And I find myself going back and looking to make sure, double checking and triple checking to make sure that I'm not missing something. But, I'm pretty confident that I'm not. But I do believe that the market just does not care about a lot of these things. The other thing I will mention is it's a game of narrative now. And I think narrative is more important. I think that the evolution of social media and now AI, every step along that chain, I think has simply magnified the power of narrative because it has amplified the voices. You can get a stock to move. If you have a lead steer out on X or gives a presentation at a widely followed value conference or something, not a value conference, but just a conference.
Are there any?
Nobody's going to that. Yeah.
There's nobody at the value conferences. I don't know if there are value conferences. So, but yeah, it's just kind of interesting. And I guess I would say I'm trying to really look at the happy side of this equation and go, well, isn't this great that I don't have a lot of competition for these fairly unique, very interesting assets that I would love to own the entirety of that business. I wouldn't want to run most of them because I'm not a business manager. I've become a lazy equity investor, but I do like being able to buy things that I think are just clearly too cheap and safe, I think. So,
And Zeke, over your entire career, I'm sure there's always probably been this like growing concern of like, gosh, what if the markets get so efficient that I'm never going to find a deal on anything really? Everything's going to be pretty fairly valued. Everyone's doing all the work. We've got, 10 million CFAs out there analyzing every company to within an inch of its life. And yet, where do we find ourselves today?
no, I think it's very interesting. I think that concern that I had was quite misplaced. Now the concern that has been replaced with a different concern, which is what's
No
going to
one's doing any work.
what's going to make the market see the value, right? What's going to force the market to reprice my security? And I am taking a little bit on faith that hey, if you just buy a good business run by good people, or it's a unique asset, that if there's competent management in place, they will find a way to get that return. Just as if you owned a private business. So, but I will say it is quite daunting when you know you believe you have a great portfolio of securities, you keep looking at them, you like what you own, and it just doesn't necessarily participate in broad market moves as much. And that is the price that you pay. So you do have to you do have to have a lot of patience. Historically, I was not as patient, and now I'm just kind of resigned to the fact that look, these guys could put out 3 quarters, 4 quarters in a row that might be great,
No
um,
one's going to care.
and I might not benefit immediately from that. And so, I think it's important to have, a strategy that when you communicate your strategy, you say, hey, this is the kind of thing that can happen. So,
My hunch is that this used to be more of a rolling thing where like you'd buy something at 5 times earnings, it would re-rate within 6 months or a year to 10 times earnings. You feel like you're kind of making good progress all the time. And it's possible that now it's more of a punctuated kind of experience. Thinking of something like Dillard's, for instance, where
yes.
you go sideways forever, it looks like nothing's happening, like you're poking the dead horse with a stick, but meanwhile, things are going pretty well internally. They're retiring a ton of shares, and then the market wakes up to it, and it's like, I don't know, whatever, did a 10x in 6 months or something. So it's possible you just have to be even more patient than ever before.
Yeah, I think that's right, and that has not historically been my strength because I just got very spoiled and used to the notion if I discover a big mispricing, the market is going to be fairly quick to tell me I'm right or wrong. And generally, obviously, you put a lot of work into this stuff. You hope you're going to be right more often than you're wrong. But typically, within 18 to 24 months, you're going to figure this out, right? The market will have figured it out. And I don't think this market can be counted on necessarily to give you that feedback with any kind of real fidelity. It will give you feedback, but it may not, it may be a lot of false feedback. It may be based on, as I say, flows out of this. Some investor has pushed a button and they're selling 400 of these shares and they're buying 300 of those. And they don't know what the stocks are necessarily. And so I just think that's quite interesting. But as I say, I'm excited about it because I feel like there's opportunity to buy really legitimately good companies at really good prices that I have not seen in a long time. So at the other side of it, of course, we have more uncertainty than we've ever had from a macro standpoint. Um, I think we talked about this earlier. I am very, very surprised that the market has recovered its losses from the tariff sell-off, particularly when you follow that up with yet another war. And I mean, every war can spin off into all kinds of other things. If history has shown us anything, wars have some of the most crazy butterfly to hurricane effects you'll find in the world, right? Because you just never know what the second and third order effects are going to be. I mean, I don't think anybody really thought that whatever that happened in 1916 that
Yeah,
kicked off World War One, would
some
have actually been,
butler made a wrong turn in Sarajevo, and
yeah,
20 million people died.
yeah, for sure. So, but I think, as I say, I like to look at the glass half full right now, and because it is really fun, you know, showing up to work every day going, wow, here's another interesting idea. And then the next day, here's another interesting idea. No, obviously not all of them end up in the portfolio, and many of them end up being, either statistical, mirages, or you just find out, once you've done the work that there's some risks that you're not super comfortable with. But yeah, I think it's a great time to be a value investor.
I've been posting these charts showing mid-cap indices against the S&P 500 or small-cap indices against the S&P 500, and they both topped out around 2011. And they've been falling pretty consistently at an increasing rate since 2011. There was a little blip, like a little heartbeat in 2020 where it sort of recovered a little bit, but we're well and truly
Is the
through the
small
bottom now.
cap premium like gone into the?
It's a small cap discount,
Yeah.
the mid cap discount, and I found the statistics for just this is the mid cap index. So this is still a market capitalization weighted, float adjusted, all that sort of stuff. But there's no value tilt or anything like that to it. It's currently cheaper and growing faster, and then that's true. That's true more so for the small cap. They're cheaper again and growing faster again, and yet can't catch a bid. Although today there does seem to be there's this massive levitation in everything in my portfolio today for
Yeah.
no reason that I can see other than today's the 1st of July.
Yeah, everyone's a
My
rebalance day at
guess
the end of
is,
the quarter.
yeah, my guess is it has something to do with Russell 2000 rebalance and quarter two to quarter three. That really incredibly important day when you go from June 30th to July 1st and everything starts over, right?
Yeah.
I don't understand it, but again, this is the type of thing where, I think there were times when I thought, hey, there's got to be a logical explanation for these things, and oftentimes there was. And now I'm just, I'm more focused on, hey, how are the assets performing, and if the market doesn't reward, good performance at the business level, I'll just kind of continue to average down or whatever it is that I choose to do. I will say the other aspect of this that I think is more challenging than ever is the short side.
Mm,
Having
yeah.
come back to, as a private investor for a couple of years, I was not on the short side. I'm on the short side again. Man, I think there are some businesses that literally do not deserve to exist that have multiple billion-dollar market caps. And that's always been the case. I just think it's really interesting now. There's
Is that
more.
quantum? Is that the sort of thing you're looking at?
Certainly it is. If there's any, and I'm not saying that all of those quantum businesses are bad businesses, and some of them, obviously quantum. I'm not a physicist, So you're going to lose me once you get past the word quantum. Uh, but I do know that there are many businesses that are in the quantum space that are publicly traded that don't have a business now and probably don't have a high probability of a business, or at least not to the extent that they can justify the current market caps. And what you see is just they all move together on an up day. So if there's some news in the quantum space where I think the most recent big one was I think Jensen Huang of NVIDIA kind of did a 180 on, hey, quantum's 20 years away. No, maybe there's a few things that might happen. And I think he probably recognizes that NVIDIA has a lot of potential to be an arms dealer to those things, whether they happen or not. But all the quantum stocks went up, and some businesses that have quantum in the name, but literally have nothing to do with
Quantum sanitary.
yes, yeah, exactly. So anyway, it's an interesting time, and I have less faith than I did that the market will sort out will do its job of kind of valuing businesses. But I guess I would say I don't believe it's ever been the market's real job to value businesses. I think it's the market's job to provide liquidity.
Mm.
And I think the market's doing that job more or less as it always has. I just think that narratives are driving price movements. Narratives and flows are what's driving price moves all the time. So it's interesting. So
Let me
Zeke
give a
on
quick
the, yeah, go
let me
ahead.
give a quick shout out, and then let's talk a little bit about your process, Zeke.
sure.
Uh, Petah Tikva, what's up? Bixby, Oklahoma, Bendigo, early stuff for you. Dubai, Lausanne, Valparaiso. Whoa, big jump. Tomball, Toronto, Tampa, Bremerton. Where are you based? Where are you based, Zeke?
I'm in South Lake, Texas, just outside of Dallas, about 15
Tejas.
minutes from DFW Airport. So
Someone gave us a question. Someone asked. Brandon, Mississippi, Portsmouth, Madeira Island, Portugal, Jupiter, Florida, South Lake, Texas, Landsberg, Germany, Highland Park, Illinois, Boucher, Iran, Breckenridge, Colorado.
So Zeke on the investment process side of things. How do you untangle and underwrite what to me feels like a very, very wide possible range of outcomes that we currently are looking at between all the macroeconomics that seems like a lot of those data points are not the most encouraging, to AI, to wars, to where's oil going? I mean, there's like so many. It's a crazy world right now. How do you try to wrap your mind around that to underwrite what your businesses might do?
yeah, it is. It's a very challenging time, as you say. And I guess I'll preface my comments by saying there's only really two times in my career that I have not kind of run into the fire to buy stocks when it was very clear the market was panicking. One time was in September of 2008 because I felt like I understood why it was panicking, and I felt like I felt like one needed to be measured. And as it turned out, I was still a little early. And then the second time was just recently with the tariffs. I chose not to. I am probably trained the way Pavlov's dogs were trained to when I'm seeing the CNN fear greed meter at 3 and everything's red.
Time to get a little
I'm gonna
longer.
yeah, I'm going to go buy something. And if I can't think of something immediately, I'll just buy whatever's got the closest ticker, I guess. Um, this is one time I didn't do it. And one of the reasons I didn't do it is, I think it was very hard to predict. In hindsight, it seems very easy to predict that there would have been some backtracking, and that it was a bit of a kind of shock and awe to get countries to the table or whatever. I still don't agree with it as an approach, even if one thinks that we need to do something about trade imbalances. I don't think the way to do it is that way. Um, but I also felt like, hey, until we get a little bit of clarity, it's just really hard for me to underwrite my businesses. Like I don't know what these businesses can do in this environment. And so what we did basically was sort of consolidate exposure into the things that we had the most confidence in. And I think that's one of the things that past sort of crises, I will call it, has taught me is get to the stuff that you feel the strongest about, but don't basically shed exposure necessarily, right?
That's
Particularly,
interesting. So, I mean, I think a textbook would tell you, like, if you're feeling risk averse, you need to diversify more. And yet you kind of went the other direction and sounds like kind of concentrated onto the things you felt like you knew the best.
Yeah, I think that's always sort of been my approach to dealing with it. And each time, sometimes you inevitably make mistakes by doing that, as it turns out, because what you feel best about is the stuff that, is probably furthest away from the fire or whatever. So, but generally what I find is that, maybe the performance isn't better off because you did that, but you certainly do catch the benefit of, you understand which names you have conviction in and which names you don't, right?
And you can sleep a
And
little easier.
sure. And if that situation had carried on for more than it did, I certainly would have been better off. So that's kind of how I feel about it. Yeah. As far as underwriting things now, we are sort of underwriting things with a bigger margin of safety than we would have, in the sense that, we kind of want better clarity that we understand the business. We want a sense of, hey, these products or services are pretty indispensable, or we just think the company's got some competitive advantage. And in some cases, we're just looking at unique assets that can't be replicated. And so eventually there will come some, I think, an equilibrium with the tariffs. And then once we know what it is, but you can't wait for a certain world, because the world's never going to be certain. But I think what kind of surprised us all was the war in the Middle East that kind of seemingly came up over a weekend. That is also very difficult to underwrite, and we're already seeing interesting things happen. So when it comes to diversity, though, I think your point is still a good one. I don't consolidate to the point where I'm holding 6 stocks or 8 stocks. I mean, we get down to the 15, 20 core ones that we really like. And if we don't like the prices we're seeing, we just, we don't sell those. But even if we have less conviction in the idea, at some price, we're just like, hey, we're going to take our chances. So, but it's a
It is
very
amazing.
difficult time. Yeah.
It is amazing how quickly the market shrugs off bad news. The tariff news is gone. There was a credit
What
downgrade in there
tariffs?
as well.
Yeah.
Moody's downgraded the US credit. It hasn't done anything.
Yeah. I think that's interesting as well. I wrote about it actually in my last monthly letter, and I didn't want to let it go by, because Moody's was kind of the last ones hanging on to this notion of there are AAA credits out there. Um, and I'm sort of surprised to see. I didn't think that it would happen in my lifetime, where I'd look up the 12 countries that are rated with the equivalent of AAA debt ratings, and now we're down to 11, and the U.S. is not one of those. And I think it's a pretty damning sort of observation. And I think Moody's is probably 5 years too late, right?
Yeah, I was going to say, it's not
Yeah.
unfair.
The horse
It's
left the
just
barn already, but
sad. Yeah.
sure.
Yeah. But it is something, look, I try not to think too much about the deficit, and I definitely, because it makes my head hurt. Um, I mean, I like to listen to my friends who say, hey, we'll muddle through somehow. But my view is that, things like that can't continue, the deficit can't continue to grow, in excess of what the economy can support forever. And so I was kind of hopeful that this administration would push it towards a better trajectory. And I think what that Moody's downgrade was the sort of the last shot that said, hey, there's a time element here that this has to be confronted. And so, but unfortunately, I'm assuming it's going to be for a future administration,
Big and beautiful problem still.
yeah, and when I say administration, I don't just mean the blue team or the red team. I mean, it has to be. This is one of those things that everybody on those teams has to at some point go, okay, we are no longer on team red or team blue. We're now on team red, white, and blue, and
Mm.
what's good for the future of our country. And I'd like to see that happen soon. So, but for now, I do think it's very interesting that if you want a AAA rated sovereign debt, you got to go to Norway or some of those places.
Yeah, I think we're down at with like Spain or Greece or something, aren't we? In the
Yeah, I don't know. I
I
don't
think the
know.
CDSs were something like that. I was like, really?
Oh, yeah, yeah. I did hear that the CDSs for the US briefly were higher priced than the CDS of Italy and Greece.
We
But
should have got away with a 100-year bond.
yeah, I
Oh
will
my
say I
God.
will
Would have
say
been
that
the time to fire it out.
I do think that America has an incredibly unique position in the world. We have incredible advantages, and I hope that that will continue, and I think it will. But I just think that every once in a while you kind of come to these moments where you kind of have to choose the right path. And so hopefully we will. So, but yeah, as far as underwriting businesses and stocks, I mean, we're looking for things that say, hey, when we look at risk, we're just kind of having to be a little bit more, I would say, creative than we were. You
Yeah, yeah.
can't be like, hey, this company competes with that company and that company. Who's better? Now you have to think about things like, hey, are people abroad going to want this American brand as much as they did in the past? And if everybody's spending 5% or 10% of GDP on defense, will there be money left for these other things? So, but that brings me to, sort of where we're seeing things in the market. I was mentioning healthcare in the US. I think that's interesting. Obviously I talked about UnitedHealth. This is a business this feels a little bit like maybe British Petroleum back in 2015 when it was still British Petroleum.
Yeah.
Or I don't know if it was 2015, but it was back when they did the oil spill, and it was just terrible front page news for it seemed like weeks on end. And at the end of the day, it felt like BP could go away, and it didn't. And if you had if you did step in there and buy it at the worst possible time, I'm sure it was some harrowing moments. But that's how we feel about UnitedHealth. Is we feel like UnitedHealth is going to survive this current difficult period. I can't imagine a stock that has a worse narrative around it right now. But if you take the time to go in there and understand the business,
What's the narrative?
well, it's not every day that the CEO of a public company's division gets shot in cold blood and on the street because people are so unhappy with
And people cheer,
the
no
experience.
less.
Yes, that's the interesting thing is
Jesus.
people were on the side of
Team Luigi or whatever the.
yeah, and I would say this. I think United Health, they need to do better. They need to do better in terms of making sure that their services are easy to understand. Um, but they're in a tough business, and I would argue that anybody else that was in their business would also kind of have the same tough hand to play. So, but we think United Health is an excellent business, and I do think that they will be kind of forced to improve certain things about their business where it touches on patient lives. And it is very frustrating, I'm sure, to deal with insurance companies, when your family's having health issues. So, but I do think it's a terrific business, and I think it will be a good business in 5 or 10 years, although it may not be as good as it has been in the past, because I think that they will probably have to earn a little less in order to get the goodwill back that they need to continue to provide, the healthcare to this huge number of people that they provide it to. So it'll be interesting to see how he goes, but that's one of those where the narrative's awful, but I think the business is still pretty good, and I think they will understand the position they're in and try to make improvements. So that's one. I do want to come back to PayPal, which we talked about last time I was on, which was, I guess, 14 months ago or so. PayPal is another interesting business that I think the narrative continues to be fairly poor. What we saw last year was the narrative really improved with the performance of the business, and the stock went from like $60 to $95. And now the stock's back to, I think, 75, but it got as low as 70 recently, when all the stablecoin announcements came out, about the new stablecoin, sort of the regulatory system around it. And what I think is interesting that nobody has brought up is that PayPal was the first consumer finance or fintech company to introduce a stablecoin with PayPal USD, which I think was in 2023, which was 2 years ago. So, but of course, PayPal stock sells off on the stablecoin news because people just assume that PayPal is not, a 21st century or a 22nd century or whatever it is, fintech. And I think that they are doing all the right things. Venmo is doing very well. Since I spoke to you guys last, the business generated another $6 billion in free cash flow. They bought back another 7 or 8% of the stock. And here it is again, trading at roughly 10 times this year's free cash flow. So we like it. It is also a very difficult one. I mean, that payment space is evolving seemingly every day. Certainly with the legitimacy of crypto and stable coins and all this stuff, there's going to be parts of that business that become more competitive. But we still believe that PayPal is a very unique asset. And, we think it's one of the better, more misunderstood, stocks out there. So we still own it. And we feel, reasonably good about it.
Thanks for that, Zeke. Jake, do you want to do your
Vegetables.
Vegetables make benefit. Glorious nation of value after hours.
Yes, sir. Let's do it. All right. So we're going to do a little history lesson here. And if you're kind of a history buff, if I were to say to you, salting the soil, there's probably one particular place that comes up, one particular civilization that comes to mind. And that's the story of Carthage. And so after Rome, the city of Carthage was destroyed. This was what was this, 146 BC. And the legend goes that they salted the earth so that nothing would ever grow there again. And this probably wasn't true in a literal sense, but symbolically it ended up being quite accurate. And Carthage was not just defeated, it was deleted. And a little background on them, they were a very powerful Phoenician city-state that was located in what's now modern-day Tunisia. And it was founded by settlers from Tyre around the 9th century BC. So, you're looking at 800-ish years maybe of being a dominant maritime and commercial empire and controlling a bunch of trade throughout the Western Mediterranean. What are we at the U.S.? Not even a quarter of that. Or roughly a quarter of it. So, then Carthage influence really peaked right before the Punic Wars, but which they were ultimately destroyed by Rome. And strangely, not all defeated civilizations disappear. Now, why is that? Ancient Greece was also conquered by the Romans, no less, and yet Greece lives on inside our language, our political systems, our schools, our aesthetics. Greek architecture is coded into our courthouses. Socrates is, still whispering in our textbooks. Rome beat Greece militarily, but spiritually they kind of lost. Like Roman elites read Greek. Their Roman children had Greek tutors. Roman gods were just Greek ones with Latin names. Greece's legacy survived because it embraced and retold, even by its conquerors, actually. So here's the mystery. Why does one fallen civilization become the intellectual father of, the modern world in the West, really? And why does the other vanish into a brief footnote? And if we can extend this a little bit, right now, which of the kind of two modern giants, America and China, who are sort of wrestling on the world stage, years from now, so let's say 500 years from now, who gets remembered as the Greece of our era, and who maybe becomes the Carthage? So let's see if we can unpack this a little bit. And this is a little bit more of a poll than it is, and I'm not going to tell you the answer because I don't really know what it is. But so ancient Greece and Carthage were both these thriving superpowers in the Mediterranean. One focused more on ideas, art, democracy, debate, and the other was much more commercially minded, navigation, pragmatic governance. It's a cultural difference, and one is sort of like immortally mythologized, and the other one disappears, right? So let's entertain like two different frames of what we can think about, and this is frame number one: is U.S. is the Greece and China is Carthage. Okay, and I'm not putting any judgments in here, so don't send me hate mail, but. So America, we export dreams, Hollywood, the iPhone, Ivy League education, all these things that the rest of the world really wants. TikTok might be Chinese owned, but it spreads Western memes. The U.S. tells stories about freedom and rebellion and innovation. These, Horatio Alger stories of lifting yourself up by your plucky bootstraps, and people. Might be driving Chinese-made cars potentially, but they're dreaming American dreams. And then China, on the other hand, right now is merchant powerhouse, trade routes, infrastructure, Belt and Road, very dominant in hard power, but I think perhaps lacking in soft power and stickiness and storytelling. Toby, you can kind of fill in some color there on our trip if you want. But but their global image kind of still struggles with a lot of like control and censorship, and their stories don't seem to travel in the same way around the globe the way the U.S. ones do. So, lest you think this is all very simple and obvious, let's try flipping this around now, and let's frame China as Greece and U.S. as Carthage. China has these very deep philosophical roots, Confucius, Sun Tzu, and it's one of the rare continuous civilizations from antiquity, and they really focus on like harmony and meritocracy and strategic patience, and these ideas run thousands of years deep. And America, by contrast, maybe we're the new Carthage in that it's kind of hyper commercialized, a naval superpower defined by trade and global bases. So which of those, I guess let's open it up to you guys. Like, which of these two framings do you find more compelling? And like who, whose story do you think will be written for the 21st century?
I'll let Toby go first.
Well, China's old world, so it's been around for thousands of years. There's written Chinese documents that I think 6,000 years old. So if you Lindy China, then China's got, we're halfway, and the US is 250 years old, but built on some philosophical traditions that are much older than that and that have been good for the world. So it's a hard one. It's a hard one, I think. I think they're both likely to survive probably in their present form for a long time into the future, would be my guess. And probably, I think there's a good comment here that said US is Rome, UK is Greece, USSR is Carthage. That's probably where I fall, something like that.
Mm.
I know that was option C. That was not an option.
Totally reject your premise and substitute my own. Zeke, what do you think?
You know, I this is a really interesting topic, I guess I would say. I think I have a personal blind spot a little bit when it comes to China because I don't travel there. Um, and so I'm not sure that I have a really good perception of what goes on the ground there from day to day. I do think that one of the things that we have in the US is we have, this we export our culture for good or for bad, and we have been very successful at doing that. I think that there are far more places you go in the world where if you get off the plane and you walk up and order a cup of coffee in English, they're going to give you a cup of coffee. Whereas if a Chinese tourist comes to the rest of the world, I think they would not probably be able to order a cup of coffee in Chinese. And I think that's probably the difference. I think that the world accepts our language and I think in many cases our norms.
Our
And so,
dollar.
yeah, the dollar being, obviously the reserve currency, I think that's a big one. Um, and while China is, of course, as you mentioned, very old and has, in many ways, a really fascinating history and legacy, the United States has probably been the more stable country for the last 250 years. And so I think that as long as we have that, as long as we have a stability, and of course, the natural resources that we have the benefit of. But I think it's the cultural resources. And I think there's also this nature that in the US, we still have the ability to say to somebody with a straight face, hey, if you are motivated and talented and you get out there, you can literally turn into the next Jeff Bezos or Elon Musk. And I think it's very interesting that the people who come to this country to do that, whether it's, Steve Jobs or Elon Musk or whomever, they invariably come to the US to create their companies. And I think that as long as that is true, I think the US will be more of the Greece
Let,
in
let
that.
me just play a little devil's advocate there, because there's definitely a view in China that you should work extremely hard and try and make as much money as you can, do the 669,
Nine
6 days a week,
996.
996,
Yeah, 9 a.m. to 9 p.m. 6 days a
6 days
week.
a week. Okay, thank
Yeah.
you. I was going to say 6 a.m. to 9 p.m.,
It
six
might,
days a week, but
they might have upgraded it since we were there.
996. Okay, 996.
Yeah.
And, they have this enormous manufacturing base now where they can pump out, goods to the rest of the world, and they are doing that. And then there was this view while we were there that China hadn't been. Some of these people that we talked to said that China hadn't been great at telling its story globally, which is funny because that's not the perspective that I get. If you watch kids television, if you watch kids movies, there's an enormous number of cartoons that have been dubbed from Chinese that tell Chinese stories in English, and they're targeted at, kids 7, 8, 9 year olds and below. So I
Hmm.
think that China's getting much, much better at telling its story. I don't know if they were ever bad at it, and I think they're pretty good at it, and I think they're targeting our kids anyway with their stories.
Yeah, I did see a news story about what the latest toy craze is a Chinese plush toy that's taking over the world apparently. So I
Is
do
that what
think
you have on your bookshelf up there in the back?
no, that's from the old Motley Fool days.
Yeah.
Yeah. Um, but yeah, I do think it'll be an interesting. It's my hope that the two countries, in their striving for superiority or whatever it is they're doing, that they actually elevate humankind altogether. Just because competition does tend to bring out the best in everybody, regardless of why you're doing it. So hopefully that'll be the case. But no, I have not spent as much time thinking about China. Certainly not on the ground in China. But I certainly respect some of those companies like BYD is an amazing company. And I think there's many companies in China that would be, if they did have the chance to tell their story, would be comparable to Tesla or the Waymos of the world, and certainly some other ones, maybe in the AI world for sure.
You want to finish it off, JT? Or
No,
that was,
that's probably enough navel gazing for one day. But it's fun to think about I mean, who knows what it's going to be 500 years from now, but hopefully we're all around to find out.
I mean, who knows what it'll be 50 years from now? But even you could even have a short-term China victory, US loss, and I still don't think that's the end of the story. I mean, short-term being like the
Sure.
next 100 years,
Could be setbacks and reversals and
there are certain geographic advantages that the US has.
huge,
And
huge natural
China has some of them
base.
too.
Yeah.
I think probably the world just continues on the way it has been. It's hard for anybody to overcome the other just because of the nature of the oceans in between and the size of the landmass, I think.
I do think it's interesting that China tends to have the reputation of being able to see further out in time, like where they're making 20-year plans and 50-year plans. And of course, in the US, we're really thinking from mostly election to election. That's the kind of difference in time horizon. So that'll be interesting to see if that plays out.
That was what they said about Japan in the 80s and 90s, that
I
the
remember.
Japanese think 100 years out, whereas America's only thinking quarter to quarter. But then maybe you got to iterate. Maybe you
Well,
got to
you need to think
change
100
quarter to
years out
quarter.
when you don't make new highs for 100 years.
Yeah, that's probably true.
Oh man.
So, Toby, coming back to the investment process, I do want to
Yeah.
touch on one thing with the few minutes of time we have left. And this was something that I thought about, probably about 7, 8 years into being a professional investor, when I kind of just took a step back and I said, well, what are the decision factors that I can control as an investor? And how can I get a little bit better at each of those? And what are they? And it took me kind of an embarrassingly long time to think about it, but I think the conclusion I came away with was there's really only four things I can control when you're talking about individual securities and decisions around them. The first one is, what security should I buy? What should I own? The second one is, what price should I pay? And then the third one, obviously, if it's not at that price or below, then you don't really have a choice of whether to buy it unless you want to overpay. But the third one is, how big of my bankroll or my portfolio to make it. And we discussed a little bit about, bankroll management and portfolio management, through the lens of
Kelly.
the Kelly formula last time we spoke. And then the last one, which took me a long time to figure out, was on the sell side. I only have the choice to sell at today's price or not, or hold on and hope I get a better price. And what I tried to do is, I had some very interesting insights when I wrote those four things down, because what I realized was paying the right price was usually not the make it or break it with a good investment or a bad investment. It was getting the right asset, buying an asset. And about 90% of the time, it was making sure that I understood it really well enough and understood that it almost every time where I got sucked into buying an asset just because of the price, I tended to, and I got many good outcomes doing that, but I tended not to have the great outcomes. And I had to be very quick to get out of the casino, if you want to call it that, before, this is more of the cigar butt type approach, the Ben Graham approach. Um, and then the position sizing was an interesting one too. And I have discovered there that, I tend to not flex up and down position sizes maybe as much as I should when new information becomes available, and I get incremental conviction one way or the other. So, and I think the part of that everybody struggles with more than anything is the selling. When do you sell businesses? When do you sell your stocks? And this, I still don't get it right a lot of the time. Um, and what I've come down to though is that, basically if I was there for the price primarily, if I was there because I thought I was getting a bargain security, then I need to get out when I get my price. And if I'm really primarily there for the business because I like the business, I have an affinity for the business and the management, and I'm convinced they can continue to create value, then I actually need to let it go further and maybe even into the slightly overvalued realm before I sell it. Um, so I'll leave you a little bit with that, and we can kind of jump off from there if you'd like, and see where that goes.
Yeah, I always that's always been the difficulty for value guys, right? Figuring out when to sell because you want to be conservative. So when you see it getting closer to value, you feel like that's the time to now it's at fair value. You're saying you can get equivalent returns from something that is risk-free, like you stick it into cash and you should be okay at that point. But the reality is that you buy these things and then they start going up, and so they get a little bit of momentum, and you're selling them right at the point that they're sort of getting maximum momentum, or they're about to have a really good year or so. And so after doing all of the work and suffering through
Hmm.
the sucky period, now that it's come back and everybody loves it and it's running, you've sold out and you're gone. You moved on.
Yeah, I think the other element of that is this is where the narrative transition takes place oftentimes, right? When you go from, oh, it's cheap, but everybody knows it's cheap because it's not very good, to, oh, wait a minute, it's a little better than we thought. And then, oh, wait a minute, it's pretty good. And then, and I mean, we probably seen this. And again, really big stocks can do this. Walmart did it. Microsoft, probably the best example. Like, it's hard to look at Microsoft now and remember a time when people kind of thought Microsoft was old tech and was really not relevant. When you look at how dominant they are today, and then there are some things like I think many of your guests have talked about Costco and how expensive that stock appears, and I would argue that it's simply being giving a huge premium for the fact that it's just performed so well for so long. And it's kind of reached the point where people are saying, hey, there's not really a price that's too high to pay for that kind of quality. Whereas I would argue there is a price that's too high to pay. And I think Costco's probably to the point where, hey, if you've owned it for a long time and you don't want to take a tax gain on it, sure. But if you were buying a stock today, I think you'd more likely be disappointed if you bought Costco at today's price. But that's just my view of that situation. But I do find that having gone through this exercise and realizing just how few points of control I really have made me want to get better control of those decision points and think about those things. And I think the process of doing that made me a better investor. And it certainly identified to me where some of my weaknesses are. And I'll just share one of them with you just because I think it might be instructive for some people, is I have a terrible fear of round tripping ideas. So I have friends that say, "Oh, I round trip stocks all the time." I'm like, I have almost never round tripped a stock. What I have done though is made a nice double in 5 years and sold only to watch that stock go up 5 times, in the next 10 years, right?
Yeah.
Or, sold and made a nice 30% return in 8 months or 12 months or 15 months, and then watch the stock continue to go up for a good while after that. And so, I think that it's very interesting that depending on how you're wired, um, what I recognize though is this fear of having a stock round trip on me was probably keeping me from staying in longer, as long as I should. And what I decided to do was where I would normally start getting the temptation to sell the stock and maybe even the entire position, I kind of make myself sell a little tiny bit of stock just to sort of satisfy that urge, and then go sleep on it, and then see how I feel the next day. And what I found is that even just doing a small action that may not have a material, monetary sort of thing, it kind of was a psychological release valve for me, and it enables me to kind of then stay with it because even if it does round trip all the way, I'll have clipped this little tiny bit of profit, right? And so I don't know if you guys have any
What,
similar
what about on
focus
the other
or
side?
whatever.
Do you have a mirror to that where you say, I like this stock, but it's too expensive probably, so I'm just going to buy like a fractional position, like less than 1%, just so I can keep an eye on it. Do you ever do that?
No, I don't. I don't buy a stock that I know is overvalued or I believe is overvalued. I do now. I will now take a starter position in a stock before I have reached like this 100% clarity that we don't have the 30-page internal document that we normally would like to have, because sometimes when you've spent, I don't know, 50,000 hours doing this, at some point you go, look, I've got to have learned something in that time. I know all the major pieces are there. Let me get started on it. And so I will have 1 or 2% starter positions and then just try to get smarter and learn more about that stock as time goes by. Whereas in the past, I would not even buy one share until I knew I wanted, until I knew exactly what I thought that stock was going to be for me. And so and I don't know if that's a big difference either, but that's a little thing that I will do. But no, I still have not yet brought myself to say, oh, I need to own this stock even though it's overvalued.
I-
Has not
I'm
happened.
one thing that friend of the show, Chris Bloomstrand, does that I always thought was pretty clever is when he's selling something, he will leave a small token amount of it still in the portfolio if it's a business that he likes and kind of wants to keep following it, and he just doesn't really like the price right now. Because it is psychologically quite a bit easier to add to a 0.5% position than to reinitiate off of zero completely. There's something about the human psyche that it's really hard to like get back in after you've already kind of sold all of it, and it just makes it easier to then ramp it back up if the price comes back to you. So it's close to buying, but instead it's just a holding of a small piece to keep your foot in the water.
I love that idea, and I think that would help me because one of the things I do like is closure.
Yeah,
I like to be able to say, hey, we bought this stock in whatever 4 years ago, and we paid 13 times free cash flow, and now I'm selling it 4 years later, and the free cash flow has gone up by 50%, and now I'm selling it 18 times free cash flow, which is fair value, and then boom, it's done. And I
right.
can
It
talk
feels good to close the book on it.
Yes,
Like
it
there's
feels great to
something,
close the book on it.
yeah,
But
human.
it's interesting that you would say that. And by the way, I think Chris is a brilliant investor, and I'm sure he's had wrestled with things like that. I'm sure he has come up with that technique in order to overcome some sort of psychological bias that he recognized that he had. But I'm going to actually write that down. I may, if I get a chance to talk to Chris about it, I will ask him about it. Because I think that's really useful. But I'd be curious if either one of you has, a psychological wiring to you that you feel like you need a little technique to override like that, or whether you think that
My
that's
whole process is built to override my urges to do anything. I'm prevented from doing anything.
Yeah, yeah. Toby's pretty well tied to the mast. I mean, Graham had that idea of 2 years or 50% up, whichever came first, for a net, I believe, if I'm recalling correctly, which I always thought was a pretty good idea.
It just truncates your winners. The only problem is it just doesn't work. It's
Well, that's
suboptimal.
what the that whole like kind of continuous return versus the punctuated. I think that like it was easier back in the day to keep that kind of motoring return going. But um,
I, yeah,
related to this though, I do a long time ago, I did a little, it was just in an Excel, it was very back of the envelope, but I took all of the studies that I could find, the value studies, these are the Tweedy Brown, the Magic Formula, et cetera, all of them. And I plotted out all those returns in, the year that they were recorded. And then I went and found as many of the kind of value investing gurus that I could, and I plotted out their returns over that same kind of time period. So it was is temporally matching studies versus gurus. And the finding was that the studies completely trounced the gurus. And which is interesting because the gurus also trounced the market. But my hypothesis as to why the studies did so well was that the gurus participate on that kind of downside irrationality. They're buying when everyone else is, kind of irrationally despondent about a business. And then they sell when it gets up to fair value, as you described, Zeke. And then perhaps the studies were participating on that downside irrationality because they, are buying cheap. And then they might have captured some of the upside irrationality as well as it moved into a momentum stock. And they just didn't
mm,
sell because it was like programmatically a timing thing. And it was, 2 years
mm.
later you sell. And that's just what it did. And then it is able to get both sides of the humanity being wrong in either direction.
There's
yeah.
also that idea that golden rule that humans tend to underperform simple statistical
True.
algorithms, and simple statistical algorithms outperform the cohort.
Even when the experts have access to the models.
That's it. That's it. The theory is that you should apply the model without messing around with it too much. We'll see.
Yeah.
Yeah,
Um,
Zeke, what do you think about that? Does that ring true for you at all?
In terms of models outperforming humans.
Well, yeah, or just maybe, you were saying that you felt like you weren't capturing any of the upside irrationality.
Yes,
enough of it.
I think
Enough of it, yeah.
yeah, and I will say too that I don't know which is the greater sin, right? When you're in a bull market, not capturing that irrational upside
Exactly right.
turns out to be a big sin. On the other hand, kind of coming back to the very first topic we talked about, which is the post-value era now, I think that there's this margin of safety concept that has slowly been getting diluted amongst value investors. And the reason is if you're really focused on margin of safety, you really probably have not kept up with what's been going on in terms of market performance. You haven't been able to own some of the big winners. And I just think that's the nature of it. And so combining that margin of safety with catching the upside that comes when, the narrative has taken a positive turn, or simply the momentum of a stock that is going up will likely continue to go up. And that is even more, I do think that is even more magnified now with the passive flows, because as new money comes in, it will go to a stock that's higher, and then that stock moves higher, and then the next flow will come in and it will go to that stock again higher. And so I think that the momentum factor may be more durable now than it's been in the past if you're in the right.
Statistically, that is true.
Yes.
It has better. It has more evidence for it, stronger evidence for it.
Yes. Whereas if you are, let's say you are equally weighted between margin of safety and trying to capture upside, I think the margin of safety piece will come in earlier than it would for many, and it will truncate some part of your upside. And I think that's what I think value investing probably does truncate some of the upside, because it used to be traditionally value investors really outperformed the market in the down markets, and in fact became a source of capital into the market to prevent stocks from going further down, because they were the ones that had the cash and they were the ones that didn't participate in the bubbles. And I don't think that's as true as much anymore either. I don't think
we got central bankers for that now. You don't need
Fewer
value
of
guys.
us. Fewer of us with no capital.
Yeah, I do think that there are other mechanisms that provide that, I'll call it that service to the market, whatever it may be. And I think there's also a lot of ETFs now that are designed to, kind of take advantage of price, weakness as well. But for whatever reason, yeah, I do think that, margin of safety is still very important, but I think it's becoming more challenging to know where to incorporate that in terms of on the sell discipline, particularly.
I think that as soon as that the small factor and the value factor start outperforming, and they've been underperforming since 2011, I think we revisit this conversation, and I think that you'll be proven right. And that's
no motivated reasoning there.
It can't go on forever. Maybe you can, but we're at time, Zeke. If folks want to follow along with what you're doing or get in contact with you, what's the best way of doing that?
Yeah, there's a couple ways. First of all, if you're a financial professional or you're an accredited investor and you're interested in what we're doing, you can email ir@ashtoncap.com, or you can just go to ashtoncap.com, go to contact us. If you convince us that you're a human being by filling in the little thing, we will respond to you. And by the way, I do appreciate, last time I was on the podcast, I got a number of very, very nice, very interesting people reaching out to contact me to talk about investing or value investing or whatever. So some very, very nice connections that were made. So I appreciate that. You guys really have cultivated a great value investing community. So
all 10 of the listeners reach
out.
That's
whoever's left.
Yeah.
Well, Zeke, Ashton Capital, thanks so much for coming and spending some time with us. We'll have you back again in the future.
Thanks, Chance.
Yeah, thanks, Zeke.
See you next time.
Oops, don't do that. Maybe.